When a business buys a large, expensive asset, like a delivery truck, they don't record that massive purchase price as a single expense on day one. Instead, accounting rules require us to break that cost down over time. This process of spreading the initial cost across the asset's useful life is called depreciation. It ensures the expense is recognized exactly as the asset helps generate revenue. There are a few ways to calculate this. This graph shows the straight line method. Notice the perfectly flat descending staircase. This represents a constant, equal reduction in the asset's value every single year, always based on the original cost. The reducing balance method looks a bit different. Here, we calculate depreciation as a percentage of the remaining net book value, creating a curving slide effect where the expense is highest in year one. Finally, for smaller items like loose tools, we use the revaluation method. You take the opening value, add new purchases, and subtract the closing value to find the year's depreciation. Selecting the correct method guarantees that the reported profits accurately reflect the real-world physical decline of the asset. Let's put this into practice with a specific scenario. We're looking at a business that purchased a motor vehicle on May 1st, 2020 for $12,500. Their financial year ends on December 31st, and they use a 20% depreciation rate under the reducing balance method. The first hurdle is the purchase date. Since the vehicle was bought on May 1st, the business only owned it for 8 months before hitting the December 31st year end. To find the year one depreciation, we take the original $12,500, multiply it by the 20% rate, and then multiply by that 8/12ths fraction. That gives us a first-year depreciation charge of $1,667. Missing that exact month-by-month fraction in the year of purchase is the most common reason final ledgers fail to balance. This examiner report highlights a specific trap. Notice the text noting that candidates did not correctly apply the reducing balance method. Many students fall into an autopilot error here, accidentally treating year two as if it were a straight-line calculation. Now it's your turn. The business sells this motor vehicle on October 31st, 2021. Pause the video and calculate the final depreciation charge. And remember, you must use the reducing balance method. Step 1 is establishing the new baseline. We take the original cost and subtract year one's depreciation to find the net book value. That leaves us with $10,833. Next, we account for the disposal date. From January 1st to October 31st is exactly 10 months. We multiply the net book value by 20% and then by 10/12ths, resulting in a final charge of $1,805.50. Adding both years gives us our total accumulated depreciation. Under the reducing balance method, year two requires that net book value step. Applying your rate to the original cost twice will throw off every subsequent entry. Once the asset is sold, we need to clear its history from the books. We do this by routing the data through a temporary disposal account. First, we remove the original cost. We credit the motor vehicle's asset account for $12,500 and debit the disposal account for that same amount. Second, we clear out the accumulated depreciation. We debit the provision for depreciation account for our calculated total of $3,472.50 and credit the disposal account. Third, we log the sale proceeds. Let's say the business sold the vehicle for $8,000. We debit the bank account to show the cash arriving and credit the disposal account. Finally, we compare the total debits and credits sitting in the disposal account. The balancing figure between the two sides represents our exact profit or loss on the sale. Locking down these specific rules for pro rata dates, depreciation methods, and double entry transfers removes the guesswork from asset tracking. You can practice running these exact scenarios right now at the link on your screen.